Welcome to Tesla Daily News Podcast for Wednesday, December 31st, 2025. Today, we're breaking down a rare Tesla move ahead of deliveries, what it could be signaling for the quarter, and a handful of product and competitive headlines that can move Tesla sentiment in a hurry. Story 1. Tesla just did something unusual before delivery numbers, and investors should pay attention. Tesla posted a fourth quarter delivery consensus estimate on its investor relations site, which is a notable break from its normal approach. The context here is straightforward. Deliveries are the most watched near-term metric for Tesla, and whisper numbers can swing the stock hard when the print hits. The key detail is not the exact consensus figure as much as the act of publishing it. That's Tesla essentially choosing to anchor market expectations rather than letting forecasts drift upward into a potential miss. Impact-wise, this can cut both ways. If Tesla is trying to reduce the risk of an expectations gap, that can lower volatility and stabilize sentiment into the release. But it can also raise questions. Why now, and what does management want the market to calibrate? Takeaway: if you're trading Tesla around deliveries, this is Tesla telling you expectations matter. Watch the reaction not only to the delivery print, but also to how analysts adjust their models and how the stock trades versus that anchored benchmark. Story 2. Tesla stock slid with big tech and options action looked mixed. Tesla shares were down about 3.3% in Monday trading, in a broader tech-led pullback into year-end positioning. The context is that Tesla still trades partly like a high-beta tech name, not just an automaker. When mega-cap tech de-risks, Tesla often gets caught in the same wave. The detail from market coverage is that options sentiment was mixed as the stock fell, which typically suggests traders are balancing near-term hedges against potential delivery-driven upside. The impact for investors is tactical. A delivery catalyst plus elevated implied volatility can create sharp moves in either direction, even if the fundamental thesis hasn't changed. Takeaway: into delivery week, the market mechanics matter as much as the headlines. If you're long, know what you own. A fundamental story with a trading wrapper. Story 3. Cybertruck demand and ramp questions are hitting the supply chain. A report highlighted a South Korean battery material supplier that ended up delivering only a tiny fraction of what was originally ordered, with the situation tied in part to Cybertruck issues. The context is that Cybertruck was supposed to be a growth and margin lever over time, but any mismatch between planned volumes and actual production ripples through partners and costs. A related report in Taiwan financial media described an originally massive contract value being revised down to near zero, pointing to large changes in expected supply volumes. Impact: this matters because it reinforces a narrative risk around the truck program. Slower ramp can mean less scale benefit, more overhead absorption pressure, and fewer high-priced units contributing to mix. Even if Cybertruck is not the majority of Tesla's volume, it influences the market's confidence in Tesla executing new platforms. Takeaway: watch for hard numbers from Tesla on Cybertruck production and delivery mix over the next reporting cycle. Supplier contract resets are a yellow flag for expectations. Story 4. China is tightening rules on Tesla-style flush or pop-out door handles. China is moving to restrict retractable door handle designs like those used by Tesla, citing safety concerns. The context is that China is Tesla's most competitive battlefield and also a key manufacturing and demand engine via Shanghai. Regulatory shifts there can quickly alter design choices across the market. The detail being circulated is a safety-driven rationale and a move toward more mechanical, accessible hardware in emergencies. Impact: near term, this is unlikely to be a financial shock by itself. But it could create incremental redesign costs, region-specific parts complexity, or lead time issues if rules apply to new vehicle approvals or refreshes. Takeaway: investors should treat this as a death by 1,000 cuts risk category. One regulation rarely breaks Tesla, but the cumulative compliance burden can compress margins, especially in a price-competitive market. Story 5. BYD is poised to overtake Tesla in 2025 EV sales, and China's EV market is shifting from boom to survival. Multiple market reports argue that BYD is on track to surpass Tesla in annual EV sales, while analysts warn that China's EV sector is moving into a slower growth, price war environment. The context: Tesla's valuation depends heavily on growth durability and operating leverage. A market narrative that China EV is a survival test puts pressure on margin assumptions and forces investors to separate volume growth from profitable growth. Details: the key theme is slowing growth and intensifying competition, not one single quarter. Impact: if competition keeps pricing tight, Tesla may need to lean harder on software, autonomy, and energy to defend gross margin and valuation multiples. Takeaway: watch pricing, incentives, and mix in China. If Tesla holds share without deep discounting, that's a win. If it has to buy volume, investors will demand stronger proof of software and services monetization. Story 6. Tesla is signaling more openness to smartphone ecosystem integration with digital car keys. Evidence spotted in Tesla's app suggests support may be coming for Apple Car Key and potentially Google's equivalent. The context is that Tesla historically prefers controlling the full stack, including the phone key experience. Opening up to standardized wallet-based car keys is a strategic choice, improve customer convenience, reduce friction, and potentially lower support issues. The details point to technical groundwork inside the app rather than a formal launch announcement. Impact. This won't move revenue overnight, but it can improve user experience and reduce churn at the margin. It also aligns Tesla more closely with consumer expectations set by other automakers, which matters as the EV market matures. Takeaway. Small software and ecosystem wins add up. For investors, the question is whether Tesla can pair these user-facing improvements with higher-margin software upsells. Story 7. Tesla showcased Optimus and Cybertruck publicly at a major Taipei auto show. Tesla participated in the Taipei New Car and New Energy Vehicle Expo, with Optimus on display and Cybertruck also appearing at the booth. The context is that Tesla wants investors to price in more than cars. Autonomy and robotics are central to the long-term bull case. The detail here is visibility. Putting Optimus in front of the public is a branding and talent recruiting lever as much as it is a product announcement. Impact. This is more sentiment than near-term earnings, but it keeps the option value narrative alive. The risk is that the market also sees how fast China is moving in humanoid robotics, which could intensify competitive pressure even outside autos. Takeaway. Treat Optimus as a long-dated call option. The nearer-term catalysts remain deliveries, margins, and progress on autonomy. That's the rundown for December 31st, 2025. The big themes today. Tesla is actively managing delivery expectations. The market is still trading Tesla like high beta tech into catalysts. Cybertruck execution is under a brighter spotlight. And China competition plus regulation remain key swing factors. For tomorrow, watch for any last-minute delivery estimate changes, volatility in Tesla options into the release window, and any incremental updates on China policy and pricing. If you found this useful, subscribe to Tesla Daily News Podcast and follow us for your daily, investor-focused Tesla breakdown.